73,366. That is the number of short contracts sitting on one side of the COMEX silver ledger right now, exposed and time-stamped, printed in black and white by the regulator for anyone willing to read past the headline quote. And yet most people scrolling their feeds tonight will see a 2-digit silver price, nod, and move on as if they just consumed the whole story. They didn't. They consumed the cover of the book and mistook it for the final chapter. The real story doesn't live on the surface. It lives underneath, in filings and spreadsheets and vault reports that almost nobody opens and almost everybody has an opinion about. Because underneath that surface quote lives a system so layered, so precisely documented, and so rarely examined in full that the gap between what people think they know about silver and what the official filings actually say might be the widest informational canyon in all of commodity markets right now. The posture tables are public, the warehouse sheets update daily, the London vault totals print monthly, the physical trust holdings carry timestamps down to the hour, and still, almost nobody reads them together. Almost nobody stacks the clocks. Almost nobody asks the simplest and most dangerous question in this entire space. What happens when 5 different reporting systems, running on 5 different schedules, start telling 5 different versions of the same story? This is OG John AG, and if you've been looking for a breakdown that treats your intelligence like an asset instead of an inconvenience, you just found the channel that does exactly that. Subscribe to OG John AG 2.0 and stay close, because every number I'm about to walk you through is something you can verify with your own hands. And that kind of transparency is not coming from your evening news desk. What you're about to hear is not a prediction. It is not hype dressed up in data language. It's an anatomy lesson on the market structure that sits behind the quote you think you understand. And if that kind of work matters to you, if you value being shown where to look instead of being told what to think, then this is the place you stay. Now, before we touch a single data point, I want to set the frame properly, because the way you enter this information determines what you get out of it. Most silver content online falls into one of 2 categories. The first is hype, loud, urgent, breathless, promising a moonshot by Friday. The second is dismissal, calm, condescending, assuring you that everything is fine and the system works exactly as advertised. Neither of those frames is useful if your goal is to actually understand what the official filings say and what they don't say. The frame I'm going to use is forensic. We're going to read the reports the way an investigator reads them, line by line, number by number, with 0 tolerance for invention and 0 appetite for denial. If that sounds boring, you're in the wrong place. If it sounds like exactly what's been missing, keep watching. Let's start where everyone starts, because there's no shame in the surface when you know it's the surface. A live silver price page can display something like bid 74.92 and ask 75.17, with a day range band sitting right beneath it and unit conversions lined up next to it. That's the number people text each other. That's the number that gets dropped into social media arguments and used as evidence for whatever position someone already held before they even looked it up. It's real. It updates. It gives you a snapshot of what one buyer is willing to pay and one seller is willing to accept in a given moment. And it is radically incomplete as a representation of the silver market's actual condition. Here's why. The same regulatory infrastructure that lets the spot price exist also publishes a weekly snapshot of futures positioning for COMEX silver. And the most recent one available is stamped Futures Only Positions as of 03/10/26. On that page, one line reads, Open Interest, 1/15th hour 4:58. That number tells you how many silver futures contracts are open and active on the exchange at that moment. Not how many were traded that day, not how many settled or expired, how many are still alive, still breathing, still representing commitment from both a buyer and a seller on opposite sides of the table. 115,458 commitments. And that figure alone should make you wonder how a market with that level of derivative participation gets reduced to a single bid-ask spread in every conversation you hear about silver on television, on podcasts, and in comment sections. But the posture table gives you more than participation volume. It gives you the lean, it gives you the weight distribution. For the category labeled commercial, the snapshot prints 31,789 long and 73,366 short. For non-commercial, it prints 33,306 long and 8,628 short. Pause on those for a moment because the asymmetry is not subtle. The commercial side is net short by a wide margin, and the non-commercial side is net long by an almost equally dramatic margin. 2 groups, 2 opposite postures, both frozen into the same official filing on the same date. And behind those category totals is the silent question that nobody in the mainstream wants to answer on camera. If the commercial side is that heavily short, what kind of price event forces them to cover, and what does that covering look like in real time? Now, a lot of people will see those numbers and immediately reach for a narrative they already believe. Some will say the commercial short position is pure hedging, standard business practice, nothing to interpret as directional pressure. Others will say it's evidence of structural suppression, a weight deliberately placed on the price by entities large enough to move markets whenever they choose. Both camps are loud. Both camps are usually arguing from memory instead of from the page. The discipline here is to do neither. Just sit with the snapshot. It says what it says. Commercial short 73,366 against an open interest of 115,458. That ratio is part of the architecture, and architectures don't care about your feelings or your favorite YouTube commentary. Now shift your eyes from paper posture to metal posture, because the COMEX system also publishes a daily depository statistics report, a spreadsheet file titled silverstocks.xls, and the one-stamped report date 3/18/2026, activity date 3/17/2026 gives you the warehouse breakdown line by line. This is where the conversation gets granular, and where most casual observers tap out because the numbers are long and the categories are unfamiliar. Don't tap out. The sheet prints total registered 78,903,367.869 troy ounces, total eligible 256,172,267.235 troy ounces, and combined total 335,075,635.104 troy ounces. Those decimals are not cosmetic. They are the exact figures printed on the report, and they represent the entire visible inventory of silver sitting in COMEX-approved depositories on that specific day, broken down into categories that the exchange itself has defined. Registered is the category that market participants treat as delivery-ready metal, silver that has been warranted and can be used to settle a futures contract without additional steps. Eligible is the category sitting in approved vaults, but not currently warranted for delivery unless the owner decides to convert it. The distinction matters enormously, because when people talk about physical tightness on COMEX, they are almost always talking about the registered number, not the combined total. And 78,103,367.869 ounces of registered silver is a figure worth watching closely, because it represents the narrow slice of metal that the system has flagged as available for settlement against those 115,458 open contracts sitting in the posture table. That relationship between open contracts and available metal is the hinge that everything else swings on, and it's the relationship that the surface quote never shows you. You can stare at bid 74.92 all day long and never know that the registered inventory sitting behind the system's settlement capability is printed on a daily spreadsheet that anyone can download. Scroll further into the spreadsheet, and the warehouses themselves become characters in this story. Asahi, Brinks, CNT, Delaware, HSBC, IDS of Delaware, JP Morgan Chase Bank NA, Loomis, Malka Emmett, Manfra, StoneX. Each one has its own line showing registered totals, eligible totals, and movements for that day, deposits, withdrawals, adjustments, and net changes all printed to 3 decimal places. And on that activity date, the JP Morgan Chase Bank NA line shows registered 11,981,013.97 and eligible 136,481,243.483 with a withdrawn figure of 1,611,910.2 on the eligible line. That withdrawal is not a rumor circulating on social media. It is a printed movement inside the vault structure on that specific day, published by the exchange itself. Then StoneX Precious Metals LLC shows an eligible withdrawn of 1,185,217.24. HSBC Bank USA shows an eligible withdrawn of 19,930.44. Put those side by side and you start to understand why daily warehouse watchers treat the withdrawn column like a vital sign monitor on a hospital floor. The spreadsheet is printing movements in real time. Metal leaving categories, metal entering categories, net changes calculated to 3 decimal places. If you want to argue that the physical silver market is calm and well supplied, you need to argue against the sheet itself, not against a headline and not against a reassuring quote from someone who has never opened the spreadsheet. Hold that warehouse image in your mind and let's shift continents, because COMEX is not the entire physical world. London is the other gravitational center, and the London Bullion Market Association publishes vault data monthly. The most recent available statement reads, as at end February 2026, there were also 27,265 tons of silver, valued at $78.3 billion. The report explicitly describes its method, published on the 5th business day of each month, reported 1 month in arrears, and it specifies what the data includes and what it does not include. It includes precious metals held within the M25 motorway area in various forms. It excludes jewelry and private retail holdings. That context prevents you from misusing the number as if it were the total silver inventory on the planet, but it also anchors you to one of the most critical physical reference points in the entire global market. London is where the OTC market lives and breathes, and these vault totals are the published window into that market's physical foundation. And here's a line that should sit with you longer than any headline ever could. The published statement includes a parenthetical, a 2.4% decrease on the previous month. That is not a guess. That is not speculation from an analyst. That is part of the printed data. London vaults held less silver at end February 2026 than they did at end January 2026 by a measured 2.4%. Direction matters. When you're watching warehouse and vault data, it's not just the level that tells a story, it's the trend. And trends whisper before they shout. By the time a trend becomes obvious, the information advantage has already moved to whoever was watching the monthly print. Now bring in a third physical reference point, because the Sprott Physical Silver Trust publishes its own holdings figure with a transparency framework that stands apart from both COMEX and London. The PSLV page states total Oz of silver held within trust 216,933,1101, with data last updated Tuesday, March 17, 2026, 6 p.m. EST. It describes the trust as holding fully allocated silver bars, names the Royal Canadian Mint as bullion custodian, names KPMG as auditor, and references a bar list by serial number along with a custodian confirmation document. That is a separately governed physical pool with its own audit trail, its own custody chain, and its own governance structure. Whether you view PSLV as a stabilizer for the physical market, a competitive pressure point against paper-heavy vehicles, or simply a transparent investment product, the number 216,933,101 ounces is a large, time-stamped, publicly stated holdings figure that belongs in any serious conversation about physical silver availability and where it is concentrated. For SLV, the official iShares page was not accessible during this research window. That's a technical limitation on access, not a conspiracy. One downstream data series that does display SLV tonnage shows values of 15,389.75 and 15,355.95 for the date 2026-03-17, labeled as daily frequency. Use those as reference points and cross-check against the official bar list when full access returns. The discipline is to never fill an access gap with a screenshot from someone else's feed or a second-hand claim from a comment section. The market punishes people who build certainty out of incomplete access, and it punishes them repeatedly. So now we've built 5 layers of verifiable data, and this is where the architecture becomes visible to anyone willing to hold all 5 at once. Layer 1 is the public bid ask, surface context, the broadcast number that everyone knows and almost everyone mistakes for the whole picture. Layer 2 is the weekly posture snapshot, leverage and positioning footprint frozen to a specific date, showing who is leaned long and who is leaned short. Layer 3 is the daily warehouse sheet, category and custody pulse, printed to 3 decimal places, with named depositories and daily movements. Layer 4 is the London monthly vault total, macro-physical anchor with an explicit reporting methodology that tells you what is included and what is excluded. Layer 5 is the physical trust holdings, a separately governed pool with disclosed custody and audit structure, time-stamped to the hour. 5 layers, 5 different clocks, 5 different reporting rhythms, all feeding into the same market that gets reduced to a single quote on your phone. And here's where the architecture gets uncomfortable, because these clocks do not move in sync by design. The depository sheet updates daily with a report date and activity date. The posture snapshot updates weekly, stamped to a specific Tuesday. London vaults report monthly, 1 month in arrears, published on the 5th business day. PSLV timestamps to the hour. When those clocks agree, the market feels stable and the surface quote feels trustworthy. When they disagree, the public price feed is where the confusion shows up first, and the people watching only the surface are always the last to understand why the price just moved the way it did. Here's where the enforcement history changes the temperature of the entire conversation, because this is the anchor that separates productive skepticism from naive trust. There is a published regulatory release describing an order that settled charges against JP Morgan entities for manipulative and deceptive conduct and spoofing involving hundreds of thousands of spoof orders in precious metals and U.S. Treasury futures. The total monetary relief stated in that release is $920.2 million. The described conduct window spans from at least 2008 through 2016. On the same date, the SEC published a press release stating JP Morgan Securities admitted findings and agreed to pay disgorgement of $10 million and a civil penalty of $25 million in connection with manipulative trading of U.S. Treasury securities, with parallel actions noted in precious metals and treasuries. These are not theories from a forum. They are enforcement actions with named entities, named conduct, named dollar amounts, and official publication dates that you can look up in under a minute. This history does not prove that every price movement in 2026 is manipulated. That leap would be lazy and irresponsible, but it demolishes the even lazier argument that manipulation in precious metals futures has never happened, and that anyone who questions the price is wearing a tinfoil hat. It has happened. It was documented by regulators. It was penalized with nearly $1 billion in total monetary relief, and it was described in official language as manipulative and deceptive conduct and spoofing, words that leave very little room for charitable reinterpretation. Not alleged, not suspected, settled, named, quantified. That single fact changes the posture of every question you ask about silver going forward, whether you lean bullish or bearish, whether you hold physical or paper. It doesn't tell you what's happening today, but it removes the intellectual escape hatch that says it could never happen, because it already did, and the receipts are public. Now here's the honest counterweight, because this channel respects the bearish case enough to present it seriously and in full. A skeptic looks at commercial short 73,366 and says, commercials hedge. Their short positions reflect business activity, not directional bets against the metal. A skeptic looks at open interest 115,458 and says, open interest can expand with normal participation without indicating crisis or impending shortage. A skeptic looks at combined total 335,075, 635.114 and says that is a substantial quantity of silver in approved vaults, and registered to eligible category shifts can happen routinely without signaling any kind of systemic distress. A skeptic looks at London's 27,065 tons and says that the LBMA explicitly frames the data as insight into London's capacity to underpin the physical OTC market, not as a warning of exhaustion or a call to arms. A skeptic looks at PSLV's 2/16,933,101 ounces and says, trust holdings are not interchangeable with retail coin availability, and the existence of a large physical trust does not prove the world is short of silver. A skeptic even looks at the enforcement history and says past spoofing cases prove that spoofing occurred in a specific historical window, not that every price move in 2026 is tainted by the same kind of conduct. That case is rigorous. It demands definitional precision. It insists on proof that connects the data points rather than assuming that proximity implies causation, and it refuses to treat suspicion as evidence. And yet the stress-watching crowd stays loud because they also have a rational foundation when they operate correctly. They don't claim certainty from a single number or a single chart pattern. They triangulate. They watch the daily depository sheet for withdrawal patterns and registered totals and net changes. They watch the posture snapshot for shifts in commercial short positioning and for whether open interest is compressing or expanding. They watch London monthly tonnage for month-over-month direction, like that 2.4% decrease printed for February 2026. They watch physical trust timestamps and holdings changes for signs of accumulation or distribution. And they carry the enforcement history as context, not as conclusion, which makes them unwilling to dismiss structural concerns as paranoia when the structural data itself is printing asymmetries that the surface quote never reflects and that the mainstream never discusses. Here is the most practical thing you can take from this entire framework, and it is so simple that it almost feels like it shouldn't work. Stop looking for a single silver truth. There isn't one. There never was one. The market is not a single instrument with a single answer. It's a web of overlapping reporting systems, each one showing you a different dimension of the same reality. Start watching for mismatches between clocks. That is where the edge lives. When the daily warehouse sheet shows withdrawals accelerating while the weekly posture snapshot shows commercial shorts expanding while the monthly London tonnage shows a decrease while the physical trust holdings hold steady or grow, you are not looking at 5 separate stories. You are looking at one system under 5 different lenses, and the mismatches between those lenses are where the real information lives. Not in the surface quote, not in the meme, not in the headline, and not in the commentary of someone who has never once opened the depository spreadsheet. That's why the core hook, open interest 115,458, matters so much more than the number itself suggests. It's a structural heartbeat. It reminds you that silver is not just a commodity sitting in a vault somewhere with a price tag attached. It's a market architecture with posture, inventory categories, vault jurisdictions, derivative layers, and an enforcement history that the mainstream would prefer you never connect to the present tense. People who trade only the surface get surprised when the price moves violently and they have no framework for understanding why. People who track structure still get surprised sometimes, but at least they know which layer broke, why the surprise happened, and where to look next for the follow-through. That is the difference between reacting and understanding. And in a market that feeds on confusion, understanding is the most valuable position you can hold. So here's the question that should keep you up tonight, not because it's scary, but because it's honest. We've walked through the bid-ask surface, the posture snapshot, the depository spreadsheet, the London vault totals, the physical trust holdings, and the enforcement history. We've stacked 5 clocks and 1 historical anchor, and every single one of them is publicly available for anyone willing to read past the headline. The question is not whether you believe silver is going up or down. The question is whether you're willing to do the work of watching the structure, or whether you'd rather keep staring at a single number on a screen and calling it the truth. If this breakdown helped you see the architecture beneath the noise, do one thing that actually matters. Send it to someone who still believes silver is just a line on a chart, because structural literacy doesn't spread through algorithms. It spreads through trust between people who respect each other enough to share what they found. Hit like if source-first analysis is what you came here for. Share this if you want fewer people trapped inside the surface narrative where all they have is a bid and ask and nothing else. Subscribe if you want to be standing right here the next time an official table updates and the clocks disagree and the surface price makes no sense without the layers underneath it. And drop a comment with the exact phrase OG John AG 2.0. Use it like a timestamp on your own awareness, a marker that says you stayed for the structure when everyone else left for the spectacle and the dopamine. OG John AG signing off. Invest with logic, not hype, every single time. When the clocks disagree, what will you trust? Read the table, ignore the noise,